In my last video, I gave you a guideline in identifying market tops and market bottoms. And that basically by tracking the movement in the dollar index and bond prices, the volatility index, and looking at the MACD indicator from a weekly perspective for both the SPY and the QQQ. So let's look at the dollar index and see what happened from a daily perspective. Did we have a confirmation from the move that we had last Thursday? Yes, we did. That tells you that there is a movement to sell stocks and raise cash. It's still small. It's still not as big as the leg that we had during the market correction in late February, but it is of notice. You have to keep that in mind, that we're raising cash here and the dollar index is crossing its moving average in the MACD indicator, which is bullish for the dollar index, not good for the stock market. Now we're going to look at the TLT, and it's a different story here. TLT closed negative on the day, just by a little bit, and it could be that the TLT is just retreating and waiting for a bigger move, meaning that the rush to exit from stocks to bonds. When people buy bonds, prices go up, yields go down. And we're going to look at the TLT closely. If the TLT starts to move down in a heavy way, that would basically tell us that this was a mere market correction and people are going to buy the dip and going to move back to the stock market. So we'll keep an eye on it. But we don't look at just one indicator. We look at all of them together. When you look at the VIX, it did close negative on the day by 11%, but it's still elevated. It's still at the high end of that explosion from that candle on Thursday. And the likelihood is when you have a movement like this on the VIX, it's not a one-day wonder when it just go the upside and then collapse. That just doesn't happen. What it's doing is taking a little bit of retreat for a bigger move to the upside, and then we'll see what happens. Again, negative news for the market. Now we look at the SPY chart from a weekly perspective and see where the MACD is. The MACD is curling down just by a little bit. Just by a little bit. So we're going to wait and see if this will continue the downside, cross the moving average or not. The likelihood is that after a reversal, it looks like a reversal. It looks like a bigger red candle next to a green candle, and it looks like there is a market correction that's just in its beginning. What I want you to pay attention to here is the RSI. I don't usually look at it from my trading practice in a normal market. I look at it when there is a big market correction, big market move. It becomes handy. And when you take a look at the move we've done in this leg before the market crash, look at where the peak is in the RSI indicator. Compare that with the peak from this last move that we've done. We're at a lower high. When did we see this before? We've seen it here. The peak in January 2018. We made a higher high in the RSI. And then we actually made a higher high on the chart, even though we made a lower high in the RSI. And what happened next is a big movement to the downside. Now let's take a look at the Qs, see where they are. And the Qs, even though they made a higher high on the chart, you take a look at the RSI again, and it's making a lower high compared to the high or the peak it made before the market crashed in late February. The RSI measures the top peaks and valleys of a certain move. And what it tells you basically, if you look at this move right here, let me turn off all these lines right here. When you look at the move here, it was mostly for green candles. It was mostly institutional buying and accumulation of stocks. When you look at the move here, there's more volatility. There's more selling. There's more profit taking. There's more short covering, there's more speculation. So this move is a lot weaker than the move we had here. Usually, where did we see that before? Again, we've seen it 2018. The Nasdaq made a top here at the RSI chart in January 2018. And even though it made a higher high by October, it made a lower high on the RSI chart. And we know what happened next, the correction. Anytime you have a weaker move, even though you made a higher high on the chart itself, you need to look at the RSI to see if there's a confirmation. Is this move really as strong as it is? Every stock in the index is participating in this move, or is it just certain handful of stocks that push the index to the higher high? And you can do that by looking at the RSI indicator. So what we're seeing here for next week is for a minimum move for the Qs to go down and touch the moving average from a weekly perspective. Now that could happen in 1 week, could happen in 2 weeks, but the likelihood is, as I explained in my previous video, there's a lot of speculation, a lot of gambling going on in the market. And the big hedge fund guys and the Wall Street firms, they don't like that. They don't like when gamblers and speculators take control of the market. What they do is they sell a lot of stocks. They take a lot of profits, crashing the market in a rapid way, in a strong, volatile way, to shake out the weak hands for the gamblers to get out of the market. And then they buy the dip and drop it over again. So this is what I see in this coming week, a continuation of the move to the downside. And let me show you one more thing, because I'm hearing a lot of people on television and other YouTube channels saying, hey, buy the banks, so there's a good opportunity in the banks. Remember, the XLF that tracks the banking sector, it never really made a higher high since the financial crisis. It never really recovered. Here's the peak in 2007. Here's the peak from 2020. We never really recovered in the financial sector. And this is a big reversal candle. There's more pain to come in the banking sector. And if there's more pain that will come to the banking sector, there's more pain coming to the stock market. Remember that the move in the stock market was driven by the so-called recovery and reopening of America, where business is just going to go back to usual. Everybody's going to start flying planes again, going to casinos, taking cruises. That is just an assumption. When you look at the realities, and I pulled up these charts from CNBC, the recovery is weaker and slower than the market expected. And it's more likely that the market will catch up with the recovery of these charts than these charts will catch up with what the stock market's done. It's meaning that the stock market will retreat and let the recovery catch up, rather than assuming or looking forward that, hey, the recovery is just going to happen in a V shape, like they're telling you. The last thing I want to show you in this video is look at this trend line, the yellow line. It goes all the way to 2009, the bottom of 2009. We touched in 2009, again in 2011, one more time, 16, again in 18, and we pierced through it during this correction, which is not a good sign, but maybe this was just an overshoot. It is a safe assumption that the SPY would go down and touch this line again before it bounces. It's not going to happen in 1 week. It could, but likelihood that it's going to take a couple of weeks or a few weeks to go there in a sustained market correction. But we'll see how that works out. So it is a safe assumption that the SPY at some point in the near future will come down to touch this line and confirm whether it wants to go up, whether there are buyers that will push the market higher, or is the stock market and the economy is really weaker than expected and it will pierce through it and go down. That's in the medium and longer term, and for now we'll take it one day at a time, but for next week I see more pain to the stock market in the SPY, specifically going down to the levels here of 286. And if you like this video, please like, share, subscribe, and comment. Let me know what you think the market will do. Thank you.